Welcome back. Today we're going to be talking about deductions and what are the major components when deciding what deductions you need to take and how in today's episode. Okay, first, before anything else, we need to understand the basics. First and foremost, we need to understand the two pathways you can take. Option one is you could take the standard deduction, which the standard deduction has increased back in 2018 with the passing of the Tax Cuts and Jobs Act. And option two is where you itemize all your qualifying deductions and total them up, okay? So now, since we kind of know what the two pathways are, let's kind of compare and contrast the strengths and weaknesses of each, and that way we can evaluate what we can do next. Okay, first let's talk about the standard deduction and why it's become the preferred method for most Americans when filing their taxes. It's worth a little bit of a history lesson in explaining why it came to be the preferred method. Before the Tax Cuts and Jobs Act was enacted, a single filer taking a standard deduction was only $6,500 for married filing jointly. It was $13,000 for head of household. It was $9,950. Okay, since the enactment, it's increased in 2022 for a single filer up to $12,950. For married filing jointly, it's $25,900, and for head of household, it's $19,400. Okay, so that's a little bit of an explanation as to why it's become the preferred method. And the reason why it might be advantageous versus itemizing is for a few, and we'll list those right now. Number one is if you itemize all your deductions, you still may not even beat the standard deduction, which means that it's still the preferred number to take, and it beats all of your itemized expenses that qualify, and your preferred deduction is the standard. Number two, it saves headaches to take the standard deduction. There's minimal paperwork with taking the standard deduction versus itemizing. And the reason for that is because if you do opt for itemizing, you have to keep a great set of records when making a deduction, when keeping a deduction, for the purpose of making certain that if in the event of an audit, you can substantiate the deduction that you claimed when itemizing. Thirdly, as we mentioned before, some people don't have very many qualifying deductions anyways. So if you're not a homeowner and you rent, you don't have very many a very large amount of qualifying deductions, and you're getting a massive jump if you just take the standard. Number four, some deductions are even still available to you even if you do take the standard deduction. These deductions are called above the line deductions. Some of them, we're not going to cover all of them, but some of them will include IRA contributions, contributions to a health savings account, and for student loan interest amounts that are deductible. This reduces your AGI, which is your adjusted gross income, okay? Now, it is worth noting that some of these adjustments do have what are called income threshold phase-outs. So after a certain threshold of your income, you may be phased out when it comes to having these deductions. Do you want to quick see what that sounded like? There was one bit, it's the last number. I can go back through here. Go. Number four is you could still take some deductions even if you do take the standard deduction. These deductions are pretty unique and they're called above the line deductions. We're not going to cover all of them today, but we're going to talk about a few big ones. A few big ones might be student loan interest, contributions to a health savings account, and contributions to a traditional IRA. These deductions will help reduce your AGI, which is your adjusted gross income. Okay, so we've kind of looked at all of these, and let's remember that some of these deductions have what are called phase-out thresholds. That means if you're above a certain threshold of income, you'll be phased out for these deductions. They're kind of like how you might get a bigger deduction if you earn less, but by the same token, if you earn more, you'll get a smaller deduction. Kind of works in the inverse. It's not exactly great. But now let's go ahead and turn to itemizing. Okay, so we just looked at the standard deduction. Now let's take a look at itemizing your deductions. First and foremost, as we just mentioned, if you're itemizing your deductions, you have to take good care and make certain that you're keeping records of everything that you're going to itemize for a qualifying deduction. This means you have to have a good set of receipts and documentation. First, there's a number of deductions that you can take as an itemized deductor, but we're not going to cover all of them. We're just going to focus on the big ones. Number one is mortgage interest. If you have a mortgage that is up to $750,000 that you took after December 16th, 2017, then you can deduct the interest on that mortgage. Or alternatively, if you took a mortgage before December 16th, 2017, and that mortgage is up to $1 million, you can take the mortgage interest and deduct that. This also applies for home equity loans that are used for a couple's principal or secondary home for the purposes of substantial improvements. And the substantial improvement is anything that is like a renovation or replacing something, or maybe like putting in new cabinets, okay? It can't just be you take out the money and then use it on a cruise line. That doesn't work. The second thing is sales tax. One of the most common is for state income taxes or sales tax. In the case of income taxes, you can add both state and local income taxes, or alternatively, you can deduct up to $10,000 of sales tax, but you cannot take both of these options. You must settle on one. Lastly, are charitable contributions. Charitable contributions is a really in-depth topic, and it can't be covered in its entirety in this video, so that'll be waited for a separate video. But let's run through a possible example to show how a tax-wise filer might be able to make a decision based on being either taking a standard or itemizing. Hi, thank you for joining us today on Tax Talks with Sam. I'm Sam Tutko. Be sure to subscribe to our channel to make certain that you stay up to date on the most current tax topics affecting your wealth.